Do you have student debt but still dream of owning a home in Hamilton? Well, you're not alone. There's plenty of people like you that have the same concern and still made it work. And don't worry, you don't have to win the lottery or move back in with your parents until you're 40. In this video, I'm going to show you exactly how student loans affect your ability to buy a home, what lenders actually look at, and how you can still make it happen. And all without ending up broke or in a house that you hate. My name is LoPresti. I'm a real estate agent here in Hamilton, Ontario. And if you're a first-time home buyer and you've got any sort of debt, maybe you got OSAP or government loans, credit card debt, you might be wondering if buying a home is even possible. I help buyers just like you every week figure out what's realistic and, more importantly, what's smart when they're buying their first home. So stick around because I'll show you exactly how lenders treat student loans and how you can buy your first home despite them, even if it feels a little bit out of reach. So the first thing you want to understand is how lenders actually view student debt. One thing that a lot of first-time buyers believe is that if they have, let's say, $30,000 worth of student loans, that there's no way that they could possibly ever qualify for a mortgage. But that's just a myth. When it comes to student debt, or any debt for that matter, mortgage lenders don't really care about the total amount of debt that you have. They only care about the monthly payments that you're making on it, because it's that monthly payment that affects your ability to pay your mortgage every month. So if you're paying, let's say, $400 per month to your student loans, that's the amount that the bank is going to be looking at every single month when they're calculating your mortgage affordability. They're not going to be looking at the $30,000 balance that's hanging over your head. That $400 per month gets plugged into something called your total debt service ratio. So this is just when the bank is determining how much of your total monthly income is going to cover your other debts. So that would be student loans, that could also be car payments, credit card loans, that sort of thing. And they're going to factor all that in when they're determining how much additional debt they're willing to give you. Basically, they want to make sure that their investment is safe and that you can actually realistically pay them back, and that you're not going to be struggling every month to make other ends meet as well. Now, here's the thing. Most lenders want your total debt service ratio to be below 44%, which means the more debt you have, the harder it's going to be to qualify for a mortgage. That makes sense, right? But here's the good news. Having student debt doesn't automatically disqualify you. It just means your buying power might be slightly reduced, especially if you're also juggling a car payment and maybe some credit card debt. So no, you don't have to worry about paying off the entirety of your student debt before you even think about buying a house. If that were true, then 90% of millennials would be renting forever or living in their parents' basement until retirement. The real key is understanding how your debt stacks up against your income and how your monthly mortgage payment will fit within those numbers. That's where a good mortgage broker will come in. So if you need a referral, then just send me an email. I've got a few options for you. All right, let's break this down with a real world example. Let's say that you're earning around $70,000 per year, which is fairly typical for somebody in their late 20s, early 30s working full time. And let's say that you've got a student loan payment of about $300 per month. Now, like I mentioned before, that monthly debt is going to reduce your overall borrowing power, but it's not a complete deal breaker. Assuming that your credit is decent and other debts are minimal, most buyers in that situation, depending on their down payment, can qualify from roughly anywhere between $400,000 to $550,000. Now, obviously, the higher the down payment you have, the easier it will be to qualify for something, but you can go as low as 5% down. That will, however, eat into your affordability because anything less than 20% down, you now need CMHC insurance, which will increase your monthly costs. Now let's talk about what that $400,000 to $550,000 price range actually gets you in Hamilton right now. There are quite a few options in that range, but if you're on the lower end, then you're most likely going to be looking at 1 or 2 bedroom condos, maybe in Stony Creek or along Rymel Road. And I'll be honest, these probably aren't going to be your dream home. You're probably not going to have the vaulted ceilings or the hardwood floors, but that's totally okay. What's more important is that you get your foot in the door of the housing market, because while everybody else is out there waiting for the market to crash, you're going to be the one building equity. Now, if you're on the higher end of that range, let's say you're around the $500,000 to $550,000, that's where your pre-approval lands you, there's some pretty solid options. Right now in Hamilton, as of the last 30 days, there are some pretty good detached options for you, mostly in areas below the escarpment, like in Crown Point or over on the East End, but there's also a few on the mountain as well. These will typically be a more preferable option than condos just because you don't have the fees. And I know a lot of people would prefer to have a detached home and having their own yard as opposed to just having an apartment or something like that. Now, are these homes at this price range going to be huge? Probably not. Are they going to be fully renovated with modern finishes? Again, Also probably not. But you're getting a freehold property with land, with no condo fees, and the ability to add value over time, even if it needs a bit of sweat equity or a fresh coat of paint. Now, another thing to keep in mind is that the type of property you buy will affect your buying power. So those condo fees that I mentioned will be factored into your total monthly debt service ratio. So the bank will actually lend you less money to buy a condo than they would to buy a detached home. I've seen some people get pre-approved for, say, $450 if it's a detached home, but only $400 if it's a condo, just because of that extra fee that they're going to be paying is going to really eat into your monthly affordability, and the bank wants to make sure that you still have plenty left over to pay them their money. So that means, all else being equal, you can usually afford a higher priced freehold property than a condo, just because there's no extra fees chipping away at your monthly income. So that's just something to keep in mind when you're comparing all your different options. Okay, so maybe you're not debt free, or maybe you don't have a 6-figure salary, a 20% down payment, or a distant aunt who wants to co-sign for you. That's fine. Your situation doesn't need to be perfect. You just need to be smart about what you do with the situation that you have and the cards that you've been dealt. Here are a few simple strategies that can help to stretch your buying power and to make lenders feel a lot more comfortable saying yes to giving you a mortgage. So the first thing that you want to do is lock in your pre-approval early, even if you're several months away from buying something. Too many buyers wait until they've actually found a home that they like before they start talking to a mortgage broker, and at that point, they're already behind. Getting pre-approved early does a couple things for you. The first is that it locks in your interest rate for the next 120 days, so you don't have to worry about that changing on you. It gives you a realistic price range, so you know what you can actually afford, so you don't waste time looking at stuff that's outside of your price range. And most importantly, it can expose any surprises in your credit profile that you might not be fully aware of. It happens more often than you think that there could be some small bill from 10 years ago that you forgot about, or there could even be a mistake on your credit report as well. So getting that pre-approval in place lets you figure out what exactly is going on and how you can fix it. So even if you're still saving up, talking to a broker several months in advance can really help to set you on the right track. It can help you to align things so you can make smart strategic moves now, so you know exactly where you're going and save yourself tons of time. Think of it kind of like you're hiring a fitness coach, right? You wouldn't start training for a marathon the night before, and you shouldn't do the same when you're buying a house. The next thing that you can do to boost your affordability is to keep your credit utilization low, ideally under 30% of your total. So the credit utilization is just the total amount of your available credit that you're actually using. So let's say if across all your different credit cards and all your different accounts, you've got about $5,000 total worth of credit. Now, of that $5,000, if you're carrying about $4,000 plus worth of debt month to month, that's not a good sign. You want to try to keep those balances under 30% of your total limits, ideally as low as possible. Make sure to pay down your credit cards and lines of credit consistently so that lenders can see that you're not overly reliant on borrowed money. Now, a little bonus tip for you. If you break up your payments into smaller amounts throughout the month, that can actually help lower your total overall credit utilization. So let's say if, in an example, in a month you spent $2,000 on your credit card. So instead of making one $2,000 payment at the end of the month, it might be more beneficial to make two $1,000 payments bi-weekly throughout that month. What this does is it keeps your total credit utilization amount lower. In the first scenario, you're letting it get up too high, getting it closer to 2,000, which raises that amount, which is going to impact your credit score. Splitting the payments up keeps that amount at a lower level and therefore can help boost your score. It's not going to be a huge difference, but every little bit helps. Personally, I set a reminder in my calendar every 2 weeks to pay off my credit cards in full, just so I don't forget to do it. Now, the third thing you can do to boost your affordability is to make sure that you don't take on any new loans before closing. Let's say that you get pre-approved, you find a house that you love, your offer gets accepted, great. Do not celebrate by financing a new car, going on a shopping spree, opening up a new credit card, or any of that. Even small loans can mess with your approval at the last second, so it's very important that you don't do that. It's one of the biggest reasons that buyers get screwed over at the last minute, and it's fully avoidable. Just don't take on any new debt in between the period when you get the accepted offer to buy your house and when you actually close on the house and get the keys. It's very, very important that you don't do that. The lender will often recheck your credit before closing, and if your debt load has changed, they can pull the plug. Now, the fourth thing that you can do to boost your affordability is to use gifted down payments if they're available. If you have parents or family members that are willing to help you out financially, then they don't necessarily have to co-sign on the mortgage. In many cases, they can simply gift you a portion of the down payment with no strings attached, other than love, obviously. This helps you out in two big ways. The first is that it lowers your total mortgage amount, which means your monthly mortgage payment is going to be lower. And then the second is that it increases your credibility in the eyes of the lender because they see that you have more skin in the game, which lowers the risk for them. Just make sure that it's an actual gift and not a loan disguised as a gift, because if it's a loan, then it technically will count towards your debt service ratio. You want to make sure that this is all properly documented and your mortgage broker can walk you through all that. Now, if all of this feels like a lot to manage, I totally get you. That's why I put together a free resource called the First-Time Homebuyer Survival Guide. It's specifically written for people like you who want to make smart decisions when buying their first home and not feel rushed, especially if you have student loans or you're trying to prepare yourself financially. Check out the description on this video so you can grab a free copy for yourself. So here's the bottom line. Yes, you can buy a home in Hamilton even if you have student debt, but you need the right plan, the right numbers, and somebody who can walk you through what's actually possible for you. If you want to chat about your budget, your goals, or timeline for buying your first home, then click the link in the bio to book a free call with me. I talk to buyers just like you every week who are figuring out their first move, and I'd love to help you figure out yours. And if this video helped, hit that button with my face on it right over there to subscribe to the channel, then click this video over here for some more Hamilton real estate tips. Thank you so much for watching. I'll see you in the next one.